With a GDP of over $4 trillion, Japan is the fourth largest economy in the world. The country is grappling with multiple challenges, such as a rapidly aging population, low birth rates, and slow economic growth. However, one of Japan's most distinctive characteristics is its heavy dependence on debt. Japan's government debt has reached approximately $10 trillion, which is equivalent to more than 255% of its GDP. This makes Japan's debt-to-GDP ratio one of the highest among developed economies. This staggering figure raises important questions about the sustainability of Japan's fiscal policy, the potential risks to its economy, and its implications for global markets. Yet, despite this record-high debt burden, Japan's default risk remains remarkably low, and the country continues to attract investors and maintain its position as a key player in the global economy. In this video, we will look at why Japan does not default despite having one of the highest debt-to-GDP ratios in the world. This video is divided into several sections, such as a comparison of Japan's debt with G7 countries, causes of Japan's remarkable debt journey, reasons why Japan does not default on its debt, and why inflation remains low in Japan despite excessive money supply in the form of debt by Japan's central bank. Comparing Japan's debt with other developed countries reveals that Japan has the highest debt-to-GDP ratio among the G7 countries. This is significantly higher than the United States, Italy, Canada, Germany, France, and the United Kingdom. For example, if we compare the US debt to Japan's, the United States has a significantly larger national debt of around $35 trillion compared to Japan's about $10 trillion. However, the US debt-to-GDP ratio is relatively lower at 123%, whereas Japan's debt-to-GDP ratio is substantially higher at 255%. It indicates Japan's more significant debt burden relative to its economy. These figures highlight the differing fiscal paths of the world's leading economies, with Japan carrying substantial debt burdens to drive its economy. How did Japan go from being a debt-free nation in the 1960s to its current position as one of the most indebted nations globally? Japan's government debt did indeed begin to rise significantly in the 1970s, following the 1973 oil supply shock. Such a disruption in the oil market led to a recession in Japan and prompted the government to implement fiscal stimulus packages to stabilize the economy. This marked the beginning of a long-term trend of increasing government debt in Japan. In the 1990s, the country's debt began to surge significantly, following the burst of the asset price bubble and the beginning of the lost decade. It was a period of economic stagnation and deflation that lasted from the early 1990s to the early 2000s. During this time, successive governments implemented fiscal stimulus packages and monetary easing policies to revitalize the economy, which led to a significant increase in public debt. Since then, Japan's debt-to-GDP ratio has continued to rise. The country's debt burden was further escalated by the global financial crisis of 2008, which led to a substantial increase in government debt. The 2011 tsunami and subsequent Fukushima nuclear disaster led to a massive reconstruction effort in Japan, causing the country's debt to soar even more. These crises led to a decline in tax revenues and increased government spending to stimulate the economy. As a result, Japan's debt-to-GDP ratio surged and surpassed 200% by 2012. Since then, Abenomics policies, including quantitative easing, fiscal stimulus, structural reforms, and negative interest rates, have driven debt levels even higher, reaching the current record level of over 255% of GDP. Additionally, Japan's aging population and low birth rate are driving up healthcare and social security costs, leading to increased government borrowing to fund these services. Moreover, the country's low interest rates and ultra-loose monetary policies, such as quantitative easing, have enabled continued borrowing and debt accumulation to run the economy. The COVID-19 pandemic also led to a significant increase in Japan's debt as the government implemented various fiscal measures, including stimulus packages, tax cuts, and increased healthcare spending, to mitigate its economic impacts. These factors have cumulatively driven Japan's debt-to-GDP ratio to its highest level in developed economies. Despite having the highest debt-to-GDP ratio among developed economies, Japan's debt management is considered effective and sustainable. As a result, Japan has not defaulted on its debt for several reasons. Approximately 90% of Japan's government debt is held domestically, making it one of the highest levels of domestic debt ownership among developed economies. Japan's debt is largely held by domestic investors, such as banks, pension funds, and individual investors. As a result, Japan is less reliant on foreign creditors, which reduces its vulnerability to changes in global market sentiments and exchange rates volatility. This unique characteristic of Japan's debt profile has helped the country mitigate the default risks associated with its high debt levels. The Bank of Japan's policies of negative interest rates and quantitative easing have kept borrowing costs minimal for the government. Such a policy helps Japan sustain its high debt levels for a long time. This approach has maintained low bond yields, making it cheaper for the government to borrow and finance its debt. Additionally, by injecting more money into the economy, the Bank of Japan is stimulating economic growth and activity in the country. By maintaining these policies, the Bank of Japan has mitigated the risks associated with Japan's high debt levels in the short run. However, experts warn that the prolonged period of low interest rates and quantitative easing could lead to potential long-term consequences, such as asset bubbles, inflation, and reduced monetary policy effectiveness. Approximately 90% of Japan's government debt is held in yen-denominated instruments, such as Japanese government bonds, which are issued in the country's own currency. This means that the vast majority of Japan's debt is not exposed to exchange rate risks, as it would be if the debt were denominated in foreign currencies like the US dollar. This unique characteristic of Japan's debt profile provides a degree of insulation from global market fluctuations and allows the country to maintain greater control over its economic policy. Issuing debt in its own currency also gives Japan more control over its monetary policy and allows it to maintain greater autonomy in its economic decisions. It helps Japan focus on addressing its economic challenges without worrying about exchange rate volatility or foreign creditor pressures. Japan's high savings rate, particularly among its aging population, provides a significant domestic source of funding for government debt. Japanese citizens and institutions, such as banks and pension funds, have a strong culture of saving and investing in government bonds. It helps to finance the country's continuously growing debt needs. This domestic demand for government debt reduces Japan's reliance on foreign investors and allows the government to borrow at lower interest rates domestically, making it easier to manage its high debt levels. Additionally, the high savings rate also provides a stable source of funding and reduces the risk of sudden changes in investor sentiment or capital flight. Japan's stable and strong economy, characterized by a highly developed manufacturing sector, provides a solid foundation for servicing its debt. The country's high-tech industries, strong export sector, skilled workforce, and robust infrastructure contribute to a resilient and sustainable economy. It helps Japan generate sufficient revenue to service its debt. This economic stability enhances Japan's creditworthiness, making it easier for the government to borrow at favorable interest rates and maintain investor confidence. As a result, Japan's ability to service its debt is supported by its economic stability, which reduces the risk of default or financial crisis. The reason why the country has not defaulted despite this increasing volume of debt is that Japan keeps the yield on government bonds extremely low. This is achieved through the Bank of Japan's unconventional monetary policy, such as quantitative easing and negative interest rates, which suppress borrowing costs. Low bond yields reduce the government's interest expenses, making it more manageable to service its massive debt. As a result, Japan has been able to sustain its high debt levels without facing a debt crisis or default. Japan's stable political system and long-term policy consistency provide assurance to investors and foster trust in the government's ability to manage its debt effectively. The country's political stability ensures that policy decisions are made with a focus on long-term sustainability, rather than short-term gains. This consistency in policy approach gives investors confidence in Japan's ability to maintain economic stability and service its debt obligations. As a result, investors are more willing to hold Japanese government bonds and support the country's ability to finance its debt at favorable interest rates. Moreover, the government's implicit guarantee of debt repayment reinforces investor confidence. Japan's low inflation rate significantly reduces the risk of debt erosion. With low inflation, the purchasing power of the yen is maintained, which ensure that the debt burden does not increase over time. This allows Japan to manage its high debt levels without worrying about inflation, as the value of the government's debt is not being eroded by rising prices. As a result, the low inflation environment provides a favorable condition for Japan to sustain its debt levels without facing significant erosion of its value. These factors combined create a unique situation where Japan can sustain its high debt levels without the fear of being defaulted. Here the question arises, why does inflation in Japan remain low, despite the Bank of Japan's substantial expansion of the money supply through quantitative easing and government loans? One key reason is the country's limited wage price spiral due to stagnant wages in Japan. The country's rapidly aging population and declining workforce contribute to a decrease in consumer demand, thereby weakening the upward pressure on prices. Moreover, Japan experienced a prolonged period of deflation in the 1990s and 2000s, which led to a deflationary mindset among consumers and businesses that prices will fall. Additionally, the Bank of Japan's efforts have primarily focused on stabilizing the financial system and stimulating economic growth, rather than explicitly targeting higher inflation. As a result, the increased money supply has not translated into higher prices, allowing Japan to maintain a low inflation rate and reduce borrowing costs and debt servicing burdens. Japan's high debt levels have a substantial impact on its economic growth. A significant portion of government expenditures are dedicated to servicing the debt in Japan. Moreover, the country's high debt burden limits its ability to respond to economic downturns or invest in strategic sectors. Additionally, the country's high debt level leads to significantly increased borrowing costs, which further reduces the government's fiscal space and hinders GDP growth. Overall, Japan's high debt burden poses a significant challenge to achieving sustainable and robust economic growth. In conclusion, Japan's high debt levels, which has exceeded 260% of its GDP, appear alarming at first glance. However, a closer look of the country's unique economic and financial circumstances reveals that why the country is unlikely to default on its debt. With approximately 90% of its debt held domestically, a stable political system, and long-term policy consistency, Japan has maintained investor confidence and kept borrowing costs low. Additionally, the country's low inflation environment, stable economy, and significant domestic savings rate all contribute to its ability to service its debt without facing significant risks. As a result, Japan's high debt levels do not pose an imminent threat to its economic stability or creditworthiness. It allows the country to continue its accommodative monetary policies and focus on addressing its long-term economic challenges.